Now, at a high level in terms of the economic impact, there are three separate things to consider, although they're obviously somewhat interdependent. The first is the direct impact, and the direct impact is that we can see with our eyes. And so it is certain activities that have more or less, or actually shut down. And this is not a normal recession. In a normal recession, consumers and businesses get less confident about things for whatever reason. They spend less money, businesses get less revenue, people start cutting back, and so on. What's happening now is an enforced shutdown as a result of policy. It's not because we don't want to go shopping, it's not because we don't want to go to a pub or go to the cinema, it's because we've been told that we can't. And the size of the downturn caused by this direct impact is enormous, and I'll stick some numbers on it in a moment. And it lasts as long as it lasts. And it will be seen through our eyes when it's beginning to come to a close, before it's seen in any in any economic data. In terms of I or we at Mercer don't have any particular insight into when the lockdown will end. We assume, as do others, that over the next few months things will be progressively loosened. Absent vaccines and treatments, certain things like sporting events and conferences, and even an event like this, if originally the plan had been for everybody to sit together in an enclosed space, maybe that won't happen for a while to come. But that things will progressively get more normal over the next few months. Absent any kind of vaccine, there is a risk of a further tick up later in the year. And so the global economy, I think, will remain nervous, whatever happens, until a workable vaccine or treatment is in place. But the direct effect will begin to diminish somewhat from where we are at the moment. The indirect impact is that coming out of this, certain businesses will be in a much less strong financial position than they were going in. So they will have had to have taken on additional borrowings. They will have suffered a good degree of stress. And that may linger for some time. And the need to pay back debt, to refinance it, to fund it, may cause business caution for its time to come. And of course, consumers may also be impacted. Some will have lost their jobs, and in addition to that, others may have been shocked because of the health impact on them and their family and their friends, and more generally the uncertainty. So those are the direct and indirect impacts, which are both very significant. And then we have the policy response, which is also massively significant. And the boost from governments, from central banks, from policymakers in general, is unprecedented and is of an order of magnitude bigger than anything we have ever seen. In a sense, coming out of the financial crisis, central banks aim to backstop the financial system, banks in particular. What governments and central banks are trying to do now is essentially backstop the whole economy. So in a sense, take the economy as where it was in the middle of March, freeze it for 3 months, and then restart it 3 months later at a cost of 25% of GDP. That cost borne by the public sector rather than by the private sector, with the goal that as many businesses remain in business when we come out of it, so they're able to take part and contribute to the recovery when it comes. So we've seen a huge amount of direct spending by governments, massive budget deficits, unlimited quantitative easing, direct lending to businesses, the furlough scheme, all sorts of initiatives to keep the show on the road so that when the economy reopens, the amount of collateral damage has been kept under control. Now, sticking some sort of numbers on the GDP impact, the blue line, what economists look at, the purchasing managers' indices, which are business confidence indicators, They're more timely than the GDP numbers. That's why people look at them. But the GDP numbers themselves, which is the orangey line, or is that, you know, brownie? Anyway, orange line, I'll call it. The first bar, which is at about minus 10% on the right-hand side, is the annualized quarterly growth rate. So the quarterly growth rate times 4 for the global economy ex-China going back to 1998. And we saw that in the financial crisis, which was the biggest downturn most people thought they would see in their lifetime, in the worst quarters, the global economy fell by about 8 to 10%. That's quarterly growth rate annualized, so 2% actual, but economists always talk about quarterly growth rates annualized. So falling at an annualized growth rate of 10% for 3 quarters in 2008. And that's the rate that the global economy seems to have slowed in the first quarter this year. But in the second quarter this year, it's going to be a lot worse. So of the order of 20%, maybe 30%, some individual countries 40, 50%. This is, as I say, quarter on quarter annualized, which is many times worse than any previous quarter seen in decades. And indeed, April is probably in growth terms the worst quarter growth rate the world has ever seen, going back hundreds of years, not that I'm an expert, going back hundreds of years. So we see a very bad first quarter, a catastrophically bad second quarter, but after that we should start to see a recovery. And that's because certain activities will go back to normal. So Bannerman's was my bar of choice. I'm sure many of you in Edinburgh probably never went to Bannerman's. It's probably a bit mucky, but it was my place of choice for many years. And my guess is that Bannerman's was shut and has been shut. And very few people will have spent any money in Bannerman's over the last 6 months or so. Or it must be the case that a few places around Cowgate probably stayed open without telling anyone. But never mind. Whereas in the summer, we are going to probably spend a bit of time doing some things. And so certain things will go from 0 up to a positive number again. And so we won't be back to the levels we saw last year, but in quarterly terms, we should see some pretty strong quarterly growth rates in the third quarter. But by the end of this year, we won't even be close to returning to where we would have been, and it'll take some time for normality. We're going to see a big tick up in unemployment, and I'm at risk of running over my allotted time, so I'll keep this quick. Unemployment in the US is likely to reach the same level as seen during the Great Depression. We're not going to see as high a level in the UK because governments are aiming to keep people in work through the job retention scheme, but we will see a big pickup in unemployment in the UK and more or less everywhere, but to potentially all-time high levels in the US. Just thinking about the restart, it's worth thinking about certain things that we will be allowed to do versus certain things that we will want to do. So at the moment, we're not allowed to, I would say not allowed to do anything. We're not allowed to do a lot. Increasingly over time, we will be allowed to do more, but there'll be a question as to whether we want to do more. And so if we were told we can go to music concerts and theatres and cinemas and all of that now, would we? So the two things to watch will be firstly, what we're allowed to do, and the second thing is what we want to do. And I think much will depend the speed of the rebound, the recovery, on whether when we get to the point where we no longer fear getting coronavirus, because either the number of cases have become de minimis, or because there's a vaccine or treatment. On the topic of vaccines, this is just a timeline for some of the potential vaccines that the scientists are excited about. Of course, for a vaccine to be worthwhile, it needs to be taken by a large percentage of the population, whereas a treatment, you just give it obviously to those who are infected. And so a vaccine given to a few million people doesn't much impact. So you both need to have one that works and one that can be produced in massive size. And nothing's likely, even under a best case scenario, this calendar year. but that's obviously one worth watching. And on that note, and in risks of, I will end, and I think we're doing questions a little bit later. You're probably not that interested in our view on financial markets. You'll be pleased to hear we don't have a strong one.